Today's webinar will be on term deposits versus bonds, and it's really a bit of a look at the defensive part of your portfolio and how adding or using some of your cash to invest in bonds will provide overall higher returns and give added protections. So before we start today, I just want to run through a few housekeeping tips. On the top right-hand side of your screen there should be a little box. If you can't see the box, there'll be an orange arrow, and if you click on that, the box will expand. About two-thirds down that box or that column is a question section. So if you have any questions at all today, please type them in and we'll attempt to answer them as we go through the presentation. Now, if we don't get time to answer all the questions, we'll certainly get back to you either by giving you a call or emailing you at the end of the session. So feel free to ask us any questions as we go along, and I think it's time to get underway. What I wanted to do today was just start with a bit of a look at term deposit rates and what's happened over the last few years with them. You can see in July 2008 TD rates were quite high and over 8%, and I remember quite well Westpac had a 5-year TD, fixed rate TD at 8%, and if you were lucky enough to invest in that, probably has just come to term about mid last year. But moving along, rates came down quickly, then shot up again late 2009, and have sort of gradually tapered off since. Now on the graph, the red line is the cash rate, currently 2.5%. The dark blue line is the average of the major bank term deposit rates, and you can see for quite a lot of the sort of the period on the graph, it's offered the lowest term deposit rates compared to regional banks and other ADIs. So the regional banks are shown as the green line, and credit unions and building societies are as the sort of the yellow or the mustard line. Now at the moment it's the regional banks who are offering the best TD rates, and about a 1-year rate of 3.9% is a good rate. I have seen a 4% rate just recently. It's probably required a higher minimum amount, but not terribly good compared to mid-2008 when they were more than double. TD rates were more than double. So low now, and I think in the context of inflation, with annual inflation last year running at 2.7%, pretty low and not really much of a real return. And when we talk about real returns, we mean the return over and above inflation. So if you take that regional bank 3.9% and deduct the inflation rate of 2.7%, you're looking at a real return of 1.2%, which is pretty low. Not going to help much in terms of paying the bills. So where are rates going? Part of our job here at FIIG, and we're always looking at interest rates and forward expectations, and one of the ways we do that is looking at the bank bill swap rate. So that's the blue line. Now the bank bill swap rate is calculated every business day, and a panel of banks submit their forward interest rate expectations into the RBA. The top two are taken away and the bottom two are taken away, and the rest are averaged to provide forward rate expectations. So because the banks are providing expectations over time, if we join those expectations we get what's known as this yield curve, and that helps us predict where banks think interest rates are going to be in future. So looking at this for the next year, banks expect in essence interest rates to remain fairly stable and not change. Moving out in 2015, they start to rise gradually, and 2016 and 17 are rising at a quicker pace, or the yield curve starts to steepen then. So looking out 3 years from now, the margin between the cash rate and the forward expectation is about 0.88%. So what that's telling us is that in that time, the expectation is that the interest rates will rise, but they're not going to rise, you know, back to that sort of 5 or 6% that they were a few years ago. That cash rate, that higher cash rate, that's still looking to be, you know, under 4%. That also sort of gives us a bit of a clue as to where term deposits might be, given that typically term deposits pay about a 1% margin over and above the cash rate. That varies depending on demand and how they can access foreign or international markets, but generally about a 1%. So even the outlook for term deposits isn't fantastic. If you were waiting or holding out for higher rates, you might be waiting for a bit of a time before you see some better rates available. Which sort of leads into why you need bonds. So bonds offer higher returns than term deposits, and that's because they are slightly higher risk. But I think that's probably one of the main advantages to them. But given a low growth economy, which is what we expect for quite a while, and low interest rates, returns are really important. Income's really important, and we know a lot of our investors rely on their investments to provide an income for them. So being able to eke out a higher income by investing in a slightly riskier asset is a very important thing. So whilst I say slightly riskier, bonds generally are very low risk and still a defensive asset. The vast majority of the bonds that we trade at FIIG are investment grade, and it's been some years since an investment grade corporate has defaulted. That was Babcock and Brown International. It was about 5 years ago. So very unlikely. Also, we think that a chance that these companies will default because there is so much money in the system, so much available credit at the moment. Okay, so we expect a low growth economy. Bonds enable higher returns. So you can increase your cash return for a small increase in risk. The other thing with bonds is that you can lock in higher returns for longer periods. So there are fixed rate bonds available now with rates of 5.5% or higher, which is better than term deposit rates. So you can lock in higher rates if you think there's a chance that interest rates might actually decline from here. The other thing about bonds, the floating rate notes. So they're the floating bonds where your income is tied to that bank bill swap rate. The income you will receive will move up and down over time, but if you expect interest rates to rise, those floating rate notes will naturally capture that higher interest rate because it's linked to that bank bill swap rate. So that can mean that you can lock into your or buy floating rate notes with the expectation rates are rising, and you don't have to worry about continually reinvesting a term deposit and seeking better returns, or being worried that you've locked into a longer dated term deposit and you have to break that or take a break fee or penalty interest to get out to capture those higher returns. So the floating rate notes at this point of the cycle are attractive to a lot of our investors. The other type of bond is the inflation-linked one. So these bonds particularly hedge against inflation and are the only security with that 100% guarantee to beat inflation. So these bonds, instead of being linked to the bank bill swap rate like the floating rate note, they're linked to the consumer price index. So as the consumer price index rises, the returns on those bonds rise. Now, I'm hoping a few of you have read a little bit about inflation-linked bonds and have some understanding of them. There's two types though, and basically the capital index bond is where the capital of the bond grows over time. So most bonds, when they're first issued, are issued with $100 face value. That's the value of the bond. With the capital index bonds, each quarter when inflation is announced, that percentage is added to the face value of the bond. So if we, and this isn't quite right, but last year's annual inflation was 2.7%. The December quarter was 0.8%. So for that December quarter, inflation, capital index inflation-linked bonds would have added about 0.8% to the capital value of the bond. Then the interest component is paid on that growing capital value. So very protective against inflation. Those inflation-linked bonds also, like the floating rate notes, they pay quarterly interest. So quite good if you're looking to build a steady income. Now the other type of inflation-linked bond is where you pay a lump sum to a company and they return principal and interest to you. Again, that's quarterly and over time, but that principal and interest payment, or the base payments, linked to inflation. So that also is very protective, I think, particularly for investors in retirement who are looking for cash flow, want to make sure they beat inflation. Those bonds give that protection. A lot of the bonds we see in the, they're called the index annuity bonds. A lot of those index annuity bonds are from very, very low risk issuers like Australian National University or the Melbourne Convention Centre, New South Wales schools. They're sorts of the issuers there. Let's move on. I'm hoping most of you understand what a bond is, but today I'm just going to explain it by referencing what a deposit is. So with a deposit, as an investor, you lend your money to the bank. If you look at a bond investors lend their money to a company. They can still lend their money to a bank, because banks are big issuers of bonds, but often you're lending it to a company. So with a deposit, interest is paid at a set period, known date, and it's defined, so you know what you're going to earn up front. Likewise, with a bond, interest payments are defined, so you know exactly when the interest will be paid to you. And you also have that surety, like you do with a term deposit, where the bank guarantees that they're going to pay you. Just the same with a bond. If you invest in a bond, the company guarantees it's going to pay you. So you're interested in the capacity of the bank or company to repay you when they say they're going to. So credit assessment, credit worthiness is a really important analysis, if you like, or assessment. In both cases, deposits and bonds, principal's paid at a defined point in the future. So you know when you're going to get your capital back, and again, generally very, very low risk. So as I mentioned before, deposits are guaranteed by the bank unless they go into wind-up, and bonds in exactly the same way, guaranteed by the company unless they go into a wind-up. It's important to note that deposits in a bank are government guaranteed up to $250,000, which does give them quite a boost, if you like, because extremely low risk. Commonwealth government guarantee we call zero risk. Bonds, though, higher risk than that. We do have credit ratings which give a bit of an indication of the risk involved. But at FIIG, we do analyse all the companies where we trade in their bonds, and those research reports are available on our website, or you can contact one of our dealers. They'll get you those reports. So I think it's really important to make the statement that bonds are a legal obligation of a company. They must pay that interest and they must pay that principal when they say they're going to, or else there's quite serious repercussions for the company. So unlike shares, for example, where companies can cut the dividends and they never actually return your investment, bonds have that requirement. The companies are required to pay that interest and principal. So as an investor, that gives you a lot of comfort that you're going to recoup your capital, unless, of course, they go into a wind-up. Okay, I can see we've had just a question from Larry, and he's asked, so ILBs are linked to CPI. That's right, ILBs are linked to the Consumer Price Index. So as that changes, so will the return on those bonds, whereas the floating rate notes are linked to the bank bill swap rate, so that's BBSW. So they provide different protections there, if you like. Okay, let's move on to the next slide. So what gives analysts and investors confidence? Well, I don't know how much you know about me, but I'm an analyst. I have been for many years, looking at companies to lend them money. So one of the things that gives us confidence in the Australian market is really that only the largest companies can issue bonds. Now, FIIG has started to bring some of the mid-market corporates to the market. We have started to help them issue bonds into the market. Even so, these companies are of a decent size. So the size of the company certainly matters as such, as does their capacity to borrow funds or to draw on shareholders of the company. So that gives us comfort. Now, with banks and insurers who are large issuers of bonds, we gain comfort from the fact that they're overseen by APRA, which is the Australian Prudential Regulation Authority. And because APRA places requirements on banks and insurers about the sorts of levels of capital they need to hold, that also gives us comfort as bond holders. Now you can see I've put in a diagram of the capital structure here, and I don't think there's any presentation I've given, perhaps I'm wrong, but where I don't include it, because I think it's really key to understanding the fixed income asset class. So what this capital structure diagram shows is the priority of payments in liquidation. I won't give a detailed explanation today, but I will run through it very quickly, so bear with me if you've heard it before. Sitting at the top, senior secured debt, so that is the lowest risk debt in the capital structure. So if a company went into wind up and the receivers came in, they started to sell down assets, the senior secured debt holders would be repaid first. And senior secured means that the bonds have defined security. So in the case of, for example, a property company, there might be a specific property that might secure those bondholders. So that property would be sold, and whatever's the sale proceeds would be applied to those bondholders. So very, very low risk. In the case of banks, they're covered bonds that sit at that level, and they in Australia are AAA rated, so rated higher than the banks themselves. Very, very low risk. So moving down, term deposits, which you're all familiar with. Senior debt. Senior debt in Australia is typically issued for 5 years, where you know after 5 years you'll be repaid in full. Known interest payments and known interest payment dates. Now, as we're moving down the capital structure, investors are taking on more risk. So senior debt, that's where senior bonds sit, senior unsecured bonds. That next level, subordinated debt, is also where bonds are issued as subordinated bonds. Now, subordinated bonds, typically the company or the bank issuing them has the capacity to repay you earlier than the final term. So typically we might say a subordinated debt is a 10-year non-call 5. So final maturity would be in 10 years, but the bond issuer has the option to repay after 5 years. So the risk that you take there is that the maturity date might be extended, and with an extension in the maturity date, there's less certainty, so you would expect to be being paid more for that risk. Moving down to hybrids. Hybrid maturity dates can be much longer dated, that final maturity date, or they can be perpetual. The interest payments can be foregone, so never have to be repaid, or they can be deferred. Those interest payments can be deferred. So hybrids, again, there's the risk of not getting your interest or it being delayed. Also the risk of a very long maturity date or a very long term to maturity. And equity or shares sit on the bottom. Of course, interest, there's no guarantee of interest, and the way you have to recoup your capital is to sell, so there's no natural maturity date. So that sort of gives you an idea of the capital structure. So what I say there is, if you have a senior bond, so you sit at the senior debt level, every rung under senior debt, so the shares or the equity, the hybrids and the subordinated debt, those three levels have to be wiped out entirely before you lose any money as a senior bondholder. So the capital structure there is providing a buffer for your investment. And we often talk about the equity buffer. Depending on the value of the equity, it can be quite high. Okay, moving to the next point. Bond prices, once they're issued in the secondary market, can move up and down. So that means that you can make higher than expected returns, but it also can mean that the price might decline below that $100. So on paper, it would seem that you make a loss. The benefit there is that if you hold those bonds to maturity, assuming the company doesn't go into wind-up, you know that you'll be repaid that $100 face value. Typically as well, any investment at any time, you will make a positive return, of course, unless the company goes into a wind-up. So you have that backstop, if you like, of knowing you'll get your capital back, which, of course, you don't have with shares. So looking at this capital structure, I'm going back to this again now for my last point. Because bonds are that legal obligation where the companies must pay the interest and principal, they're going to protect bondholders at the expense of shareholders. So, for example, if things aren't going so well, I don't know, there's a downturn in the mining industry or commodity prices, and say a mining company hasn't earned what it expected, maybe it's made a loss even. One of the things that company has an option to do is to cut its dividend. And we've seen that through the GFC. Even the big four banks cut their dividends. So cutting dividends is one option that companies will use to protect bondholders. Rights issues, another. Also like sale of prime assets. And that may be very much against the wishes of the shareholders, but if they can raise money to repay debt holders, that will ensure the continuity of the company. So there's some of the sorts of things companies will do to protect bondholders. Now, I've just got a little tip at the end of the page there. It's really important when you're investing in anything to try and get some research, and fixed income research is really quite different to equity or share research, and that's because the drivers are different. Very much, if you're buying shares, you're interested in growth. That's what's going to drive your share price higher and your dividend higher. Whereas bond analysts, fixed income analysts like myself, growth often means higher risk, so it can be like a red flag. But we're very comfortable with companies that just year in, year out have consistent returns and stick to their knitting, if you like, because those companies will pay us our interest and principal when they're due. So quite different drivers. I'd certainly get hold of any research you can before you invest, and look at the company website on the net. But be wary of using equity or share research to make a decision about a bond investment. Now I can see we've got a few questions here. Cameron, do you want to answer one or two of those while I have a quick sip of water?
Yeah, sure, Liz, absolutely. There are a couple of questions here, and I guess one which I thought I might answer is the question was whether BBSW and CPI accurately track each other or whether there are differences. They are quite different, though there are some correlations between the two. They can act relatively independent of each other. Now, right now what we're seeing is some rises in CPI. That's not necessarily correlating through to interest rate growth or bank bill swap rate growth. In essence, the RBA will move interest rates in order to control inflation, such that, and that was evidenced yesterday, the RBA coming out saying that they've removed their easing bias and now maintain a neutral bias, and that's because inflation has started to increase. So what that says is the RBA is less likely to reduce rates any further, because a reduction of rates would further probably grow inflation. So they're not going to cut rates while inflation is on the rise, and in fact, if inflation were to get above that 3% mark, it's currently 2.7% year on year, then the RBA would look to raise interest rates to curb inflation. So BBSW really follows the cash rate very closely, whereas CPI, of course, is simply the growth in a selected basket of goods. On top of that, there's a question there around whether term deposit ETFs offer any value. Yeah, there's a range of ETFs in term deposits and fixed income now, and the difference between ETFs versus direct ownership of bonds are that an ETF is a fund of sorts, so of course you're impacted by the actions of other people, and you need to be able to sell out based on where that fund is. And of course we've seen in times of distress when there can be a run on a fund that the last person holding in that account is generally worst off. So we would advocate direct ownership of bonds or term deposits, in that you alone control what your investments are and know what your investments are, and you make those choices as opposed to a fund manager of sorts.
Okay, thanks, Cameron. Just one more quick question before we move on from Jane, and she's asked, is there a secondary market for hybrids and sub-debt, which could alleviate the worry of long maturity dates? Very good point, Jane. Of course, there are ASX-listed hybrids and subordinated debt, but also wholesale. There's also the wholesale over-the-counter market, which is huge and very liquid. So there is an active market, and in fact at the moment our issue is actually sourcing the bonds, because the demand actually far outweighs the supply. So it's sourcing bonds is part of our problem. But of course we can source bonds, just at different times. Some are harder to get than others. But yes, active secondary market. So even with longer maturity dates, if you don't want to hold bonds, you can trade or sell them. Okay, I'll move on from here. Still got a bit to get through. So current bond strategies. We certainly think rates will be lower for longer. That chart early on showing BBSW, we think they're going to be lower rates for quite a longer period. And front of the AFR today, we see Joe Hockey going to, or suggesting he might release some of his budget material early, so everyone can get comfortable with the sorts of cuts that they're thinking about making. Of course, when the government cuts spending, it impacts growth. So I think all the signals are there that we're in for a low growth and low interest rate environment for longer. So given that sort of environment, we would still recommend buying fixed rate bonds, because they are offering higher income. Some of the best bonds available at the moment are out to sort of a 7-year period, and again, some of the rates are 6%. You can get over 6% on some of those fixed rate bonds. We still also see, of course, value in the floating rate notes at this point in the market, when the rate cycles getting near the bottom. A lot of the better value in the floating rate notes has gone, and of course if you buy them at the moment, your income is typically quite a bit lower than the fixed rate bonds. But there are some good ones out there, and we'll talk about a couple as we near the end of the presentation. So inflation-linked bonds, they're certainly where we think if you're new to investing in fixed income that you should consider purchasing. Because these are the only securities with that 100% hedge, they also are offering real yields, and that's over and above inflation, of up to 4.5%. Now, if you just look at that real yield amount of 4.5%, that's better than the best term deposit rate. So your actual returns are sort of nearing 7% on some of those bonds. Again, as Jane suggested earlier, that it's you know, they are longer dated bonds, but you can sell those bonds if you choose to. So what I'm going to do today is just run through a couple of portfolios, and I'll do this fairly quickly. Portfolio 1 is going to just demonstrate sorts of returns with no bonds, and then I'm going to show a second portfolio where some of the cash is allocated to bonds. So in this first portfolio, term deposit allocation is half, so 50%, $250,000 allocation, using that best regional bank term deposit rate of 3.9%. For the coming year, you would earn $9,750 on that investment. Now the equity or the share allocation, I'll keep the same over both portfolios. Again, half of the allocation to shares, $250,000. Now I think I'm being quite generous here, but I make the assumption that shares this year will earn 10%. I think that's probably higher than I truly think, but given the example, it doesn't make too much of a difference to the example. So 10% return on $250,000 is $25,000. So total return for this portfolio projected for next year is $9,750 plus $25,000 equals $34,750, or 6.95% as a percentage of the funds invested. Okay, moving on. So the second portfolio, what I've done is reduce the term deposit allocation. So I've kept $50,000, so around about 10% still in cash, and I've used $200,000 to allocate to a bond portfolio. So running through this, invest for 1 year, the 50,000 TD at 3.9% provides $1,950 income. The bonds, $200,000 by 5.73%. That's actually the running yield on my portfolio, and I'll explain all of that as we go through. So whilst it might look like a figure I've plucked from air, it isn't. So that return, return on the bond allocation is $11,460. Share allocation, still $250,000 at 10%, $25,000. So still the same return for the shares. So total return for the second portfolio is $1,950 for the term deposits, $11,460 for the bonds, and $25,000 for the shares. So total return becomes $38,410, or 7.68% as a percentage of the funds invested. Now comparing the two portfolios, Portfolio 2 earned $38,410 versus Portfolio 1 $34,750. So the difference here is $3,660. Which we think is a lot of money if you're trying to live off the income of your investments. Also, it's a lot of money when you consider the compounding over years, future years. So $3,660 or plus, your total earnings are up 6.21%. So now let me get into the explanation of how I get all these figures. Now I'm wanting to explain more and more about how things are shown at FIIG, and if any of you have received a suggested bond portfolio, it will look something like these next two pages. So I want to talk you through the different columns, but I'm also showing you the bond portfolio. So I'm not recommending this bond portfolio at all. I've just chosen 4 bonds with different characteristics to demonstrate some of the columns and some of the workings, but I have used that. So looking at this first page, the 4 bonds I've chosen are Silver Chef. So Silver Chef was the first mid-corporate bond that we issued just over a year ago now. So it has a call or maturity date. That's the second column of 14th of September 2018. So that's the date when you can expect to receive your funds. Moving along the columns, the coupon. The coupon is the interest, the stated interest at first issue. So when Silver Chef issued the bond, they said they were going to pay 8.5% on the value of the bonds. They still pay 8.5% of the value, but there's a few other little tweaks which I'll explain as we can keep moving along along this page, along the columns. So coupon type. This particular Silver Chef is a fixed rate bond. So the Silver Chef company pay out 4.25% coupon for each $100 face value. Remember, the bonds are issued at $100. Moving along, capital structure, senior debt. So if you go to that capital structure diagram, this senior debt sits high in that capital structure diagram, which gives you some comfort. Trading margin. Now, trading margin. If you remember that very second graph I showed where we had the cash rate and the BBSW rate, in effect that trading margin is the rate you can expect to earn over and above the bank bill swap rate, or that yield curve, that curve. So it's additional margin you would earn over the banks, if you like. The trading margin is used by a lot of institutional and wholesale investors as a measure of risk. So the higher that trading margin, the higher the perceived risk of the bond. And you'll see there the Silver Chef is the higher risk of the bonds that I'm showing you today. So moving across, yield to maturity. So this is the return you can expect to earn if you hold a Silver Chef to maturity. So 6.64% there. But you'll see that that's actually lower than that coupon rate of 8.5%. And that's because that tells me that these bonds are trading at a premium. So they're trading at more than $100 at the moment. So if you wanted to buy a Silver Chef bonds, you would have to pay over $100. And because you're paying more to get that 8.5% return, it reduces that return, if you like. I'm hoping you understand that. But the running yield is still high. The running yield's the income you would expect to earn for the next 12 months. So that's still up around 8%, which is a very good return in this market. Now just run through the other bonds on the page. The second is the Bendigo and Adelaide Bank. That's a subordinated debt. So if we go across to capital structure, it's got lower tier 2. That means subordinated debt. And that's, again, on that capital structure diagram, we're coming lower in the structure because we have confidence that Bendigo and Adelaide Bank will repay as they say that they're going to. Now, because we do that, we should be earning more for that bond than what the senior bonds would return. I'm going to go back to that second column, the coupon. So at first issue, this Bendigo and Adelaide Bank bond was showing a coupon of 2.8%. And in fact, I'm pulling myself up here. I'm going back to the call maturity date. Sorry about that. The very first column. So the very first column, Bendigo and Adelaide Bank have the opportunity to repay you on the 29th of January 2019 the amount you've invested. They don't have to, it's not a requirement. Most of the banks generally in Australia have called or repaid at the first opportunity, so most of them have done that at that historically. So So we have quite a lot of confidence that that will happen again. If they don't repay, then there's the chance it will extend to 2024, that maturity date on that subordinated bond. Okay, now I'm going to move ahead. I'm jumping now, sorry to make it a little bit confusing, to the coupon type. So it's floating. The Bendigo and Adelaide Bank subordinated bond is floating rate. Trading margin 2.43%. That's pretty good margin for the institution. Yield to maturity 6.06%. That's a good return, as is the running yield of 5.35%. Now you'll see that coupon there at 2.8%. That is plus BBSW. So because it's floating, it doesn't show the whole amount because that whole amount would change on a daily basis. So it's because that lower coupon really tells me it's floating, so it's BBSW plus 2.8%. BBSW is running at about, what is it, 2.5 cam or thereabouts, about 2.5. So it's paying, it's that running yield is lower than the 2.8% original coupon, which means again that this bond is trading at a premium over that $100 issue price. I'm hoping you're all keeping up with me. Please send in lots of questions and we'll answer them at the end of this page. I'll just run through these other couple of bonds quickly. So the next one is Dampier Bunbury Natural Gas Pipeline Finance Corporation. This is an infrastructure bond maturing 2019. It's fixed rate. Original coupon was 6%, but yield to maturity is lower, 5.35%. Again, this bond will be trading at a premium. It's fixed rate, it's senior debt, low risk bond, but running yield or income next year projected at 5.82%. Now the reason the running yield's higher than the yield to maturity is because when you pay that premium on the bond, say the bond would cost $105 and the company is only ever going to pay you the $100 at maturity. So in effect, you over the life of the bond, you make a small loss on the capital if you hold to maturity. But the yield, you should concentrate on that yield to maturity because that incorporates that small loss over that time. So if you think the 5.35% is still a good rate in this environment, you would look to buy that. If you're particularly worried that you might make that small loss at maturity, you can sell prior to maturity. And we certainly have investors that do that buy fixed rate bonds to lock in the higher income and then seek to sell at later dates. Now the last bond here I'm showing is Sydney Airport. It's got a longest dated maturity, if you like, and it's an inflation-linked bond or a capital index bond. So the coupon type there, you'll see CIB, which stands for Capital Index Bond. We have that second type of inflation-linked bond, the IAB, so it could say IAB there in coupon type. This coupon is, going back one column again, the coupon on the Sydney Airport, 3.76%. It's senior debt. I'm moving across the right here now. Trading margin 2.42%, so similar risk. The market's saying similar risk to the Bendigo and Adelaide Bank sub-debt. But yield to maturity here, 6.4%. And you'll see a little asterisk there, and that's because the FIIG model makes an inflation assumption of 2.5%. So that's added in to give that 6.4% overall yield to maturity. Now inflation can be higher or lower, but we just stick to that 2.5 because that's the Reserve Bank midpoint of their target 2 to 3% inflation range. Running yield. Now that's quite low, that 3.8%, and that's because it makes no allowance for inflation in that. even though inflation is accumulating in the capital value of the bond, and that margin is paid on that growing capital value, there's no allowance for CPI there. So it's actually worse than what it truly is, but that's how the model shows. It shows it at 3.8%. Now, I'm hoping you followed what I've been talking about, and I can see a whole lot of questions, so I'm just going to hand over to Cam to answer a couple for you now.
Very good, thank you, Liz. The first couple of questions there, the first one from David and also from Trevor relate to tax. Now, we generally will try and avoid questions relating to tax because, of course, we're not licensed to be able to give tax advice. With regards to bonds, income from bonds is taxed as income in the same way that any interest you receive from a term deposit is. And also with Trevor's question, with regards to the taxation implications on ILBs. Everyone's tax situation is different, so obviously we can't factor in tax into overall return because depending upon the stage of your super fund, etc., you could pay 0% tax or you could pay 40% tax depending upon your own particular circumstances. So probably better to talk to your accountant with regards to those sort of questions. Moving on to John Fitzsimmons' question there. The sample bond portfolio table shows Silverchef as both the lowest risk in that it's a senior debt and highest risk in that it has the highest trading margin. Now, that's because Silverchef, of those 4 companies shown, would be the smallest company. So if you're looking at Bendigo and Adelaide Bank, Sydney Airport in particular, these 2 institutions are massive organisations with considerable market cap. So so if you look at Sydney Airport, I believe the market cap on Sydney Air is around $6 to $7 billion. Silverchef market cap is more in the 200 to 300 million range. So it's a much smaller entity, and therefore, regardless of its position in the capital structure, one would assume that a small company like Silverchef is a higher risk than a Sydney Airport or a Bendigo Adelaide Bank. So that's that one. Jackie Chang asked a question about buying a bond at the IBO at the issue. Would you receive the coupon rate until maturity and not the running yield? Yes, that's correct. If you were to buy a bond at par at a price of $100, then the yield to maturity would be equal to the coupon. So on that Silverchef bond, for example, if you had been able to buy that at issue when it was new, it would have cost you $100,000, say, to buy X amount. You would have received 8.5% or $8,500 per annum, and that would become both your running yield and your yield to maturity because there's no differential there. A couple more questions here coming through. Ramon has asked just a little bit to explain around the State Treasury Corp's bonds. So the largest issuers of bonds in Australia and in fact around the world are governments. And in Australia that means we have federal government bonds and we also have state government bonds. So each particular state will fund themselves with bonds, and certainly you can access any state government or federal government bond that you wish through FIIG. They tend to work as a hedge in your portfolio such that people flock to safety, and safety is government bonds in times of financial distress. So they can play a really important role as a hedge in your investment portfolio. Moving along, Peter asks, what is the risk of the government changing the rules so that they're devalued in terms of Sydney Airport? I'm not exactly sure. I'm guessing you mean probably around the, the big question we get on Sydney Airport is what about a second airport? And interestingly enough, that looks like there may be news on that just this morning. We don't perceive that as a risk here because the only reason that they would ever build a second airport is because the first one is full. So I think Kingsford Smith will always remain the premier airport in Sydney. Melbourne has 2 airports. Tullamarine will always be the premier airport over Avalon. So I'd suspect that probably when as opposed to if, a second airport is built in Sydney, I think it's at least 10 to 15 years away, and I think it will always be a secondary airport. So Sydney Air in general, as an entity, is performing very, very well. So that's one that we definitely like. Last one I'll do, Mark. Not using abbreviations. Yes, okay, got it. Can do that, Mark. I'll point that. I'll make a note of that, and also talk with Liz. Okay, Liz.
Great, thanks, Cam. So this second page is a continuation, if you like, for the first, and it would run across. So if we send to a portfolio for consideration, it would have all these columns and it would run across the page. So I'm moving across here, starting with Silver Chef. Again, we've talked through the four companies. I'm just going to run across what the columns mean. So the first one is modified duration. And what modified duration shows is the bond's sensitivity to interest rates. So the fixed rate bonds and the inflation-linked bonds have a higher sensitivity to changes in interest rates. So you can see Silver Chef and Dampier Bunbury and Sydney Airport, modified durations, the lowest are with Silver Chef of 3.69, the other two are up over 4. So if you hear about duration, a lot of institutional and wholesale investors, again, they're wanting a mix of durations in their portfolio to diversify it and make sure that they aren't, don't have all their risk in one part of the curve, if you like. So the Bendigo and Adelaide Bank one there, that's the floating rate bond. Now, because with floating rates bonds, the way the interest rate is calculated is that at the coupon payment date or the interest payment date, they take BBSW as of that day, and that then sets the rate or the interest rate for the coming quarter. So it's the BBSW plus the margin, and then so investors know what interest will be for the coming quarter. But because that interest rate's reset quarterly, it's a very low modified duration, so low risk or exposure to interest rates and sensitivity for that floating rate note. Okay, moving along, capital price. So as I mentioned earlier, all the bonds are issued with $100 at first issue, and Silver Chef's trading at a premium of 107.25. Bendigo and Adelaide Bank, now that was only issued last month, and it's also trading at a premium of 101.58. Dampier Bunbury, again a small premium, 103.14. Now Sydney Airport, that capital price is much higher, and that's because that capital index bond, the CPI, since the bond's been first issued, has been added into or multiplied to get that capital price. So the capital price, 128.22, is much higher. Now, that's a little bit of a misstatement, because the capital price is the market, what the market values that bond at, and the true value is, I think, is that trading at a small discount to face value, Cam? Is that right?
Just at a slight discount, yeah, and that's why we see coupon 3.76, running yield 3.8, suggests that it's trading at a very small discount. Okay,
thanks for that. Okay, so the next one, face value. So that's the amount or the original value, if you like, that you're buying or you would be buying or selling. So I've used $50,000 for the top 3 bonds, and I've actually used $40,000 for the inflation-linked bond, and I'll explain why in a minute. But that means that current actual value or face value on that bond is $51,788. So if you if Sydney Airport had to repay you today, and you'd invested originally, when it first issued, you invested $40,000, it would now be worth $51,788. So that would be what they would have to pay you. So moving along, capital value. So current capital value of these bonds is, let's just use Silver Chef, $53,625. So that's the amount you would have to spend to get that $50,000 face value. You have to spend a bit more because the price is higher on that bond, but you're in effect buying $50,000 worth of face value. The next column, accrued interest. So as soon as bonds pay their interest payment on whatever date that is, interest then starts accumulating from the next day. So the way the market works is that when you buy a bond at whatever point in time, you pay the seller the interest that they would have had owing to them. So in this case, if you bought Silver Chef as at the 30th of January, you would have to pay the seller interest of $1,691. But what happens is, with that interest, is that the very next payment date you'll repay that interest in effect. So if you bought a floating rate note 6 weeks after the last interest payment date, you would have to pay the seller 6 weeks interest, but because it's only 6 weeks until the next interest payment date, you would get your half of the interest, and you would also recoup that interest you'd paid the seller. I'm hoping that makes sense. So total value for Silver Chef, if you wanted to buy that bond as at the 30th of January, would be $55,316. I won't explain the others because I'm hoping capital value and accrued interest, you understand that. But you'll see the total value of the bonds in this little sample portfolio is just over $200,000. Now, the reason I had a smaller value on Sydney Airport was to try and get this little portfolio as close to $200,000 as possible for the illustration of the difference in the returns between having half cash or term deposits and shares, or 10% cash, 40% bonds, and 50% shares. So I want to move on because there's a few other things I'd like to show you. So when we construct portfolios, there's a whole lot of bond portfolio statistics that come out in the report. So I just very quickly wanted to run through these. One of the tables is sector exposure. So this particular small portfolio has 24.14% allocation to regional banks, 75.86% allocation to others. Capital structure exposure, 75.86% to senior debt and 24.14% to subordinated debt. That LT2 is lower tier 2, and it's a technical term for banks. In essence, they hold those funds to help meet capital demands of APRA. That's very technical. I won't go into that. Okay, so portfolio exposure statistics. So the weighted average yield to maturity of the whole portfolio is 6%. So if you held all those bonds until maturity, that would be your expected return. So the weighted average running yield or income, 5.73%. Now I've highlighted that figure because that's what I used going back to the earlier income differential between the two portfolios. That's where I got that 5.73%. Weighted average term to maturity, 5.52 years. Weighted average modified duration, 3.41. That's that sensitivity to interest rates. Weighted average trading margin, 2.28%, and weighted average credit rating of BBB. So very comfortably investment grade. We do make a note there, Silver Chef isn't rated, so that's the weighting of the remaining three. Okay, I can see a question here. Ramon's asked, can you explain what the column headed percentage exp means? That's percentage exposure. So that's exposure to a sector or to a company. Okay, and dirty price, Peter, I'm coming to that. So, oh, actually I've gone past, beg your pardon. Dirty price is the price of a bond that includes accrued interest. So accrued interest I'll go back again. You can see at the very bottom of this slide, clean price equals dirty price minus accrued interest. So dirty price includes interest, accrued interest, clean price doesn't include interest. Okay, a few more bond statistics, portfolio statistics for you. This is the product split. So fixed rate bonds, floating rate bonds, capital index bonds, index annuity bond, other. So this portfolio, 48.29% fixed, 22.77% floating rate notes, and capital index bonds, 28.94%. The credit rating split. So we have 75% in that triple B range and 24% in the other. So that's the silver chef there. Again, the output on our model will show you the cash flow that you can expect for the life of your holdings. So this particular cash flow I've done on a quarterly basis. So I have the 4 bonds there and over the 2 years. So looking at just this year, first quarter, Silver Chef will pay $2,125. Sydney Airport will pay $487. That's our projected amount to provide total cash flow of $2,612. Right, next quarter, Silver Chef, you can see there, doesn't pay any interest, and that's because it's a fixed rate bond, so it only pays half yearly interest. Bendigo and Adelaide Bank, the floating rate note that was issued just in January, starts to make interest payments, so $778. Dampier to Bunbury, that's another fixed rate bond, $1,500. Sydney Airport, $490. So projected income there is $2,767. Going into the third quarter 14, you get Silver Chef paying again. Bendigo and Adelaide Bank, that'll pay every quarter because it's a floating rate note. So you get that more consistent income, if you like. Dampier to Bunbury doesn't pay. Again, Sydney Airport, that's the inflation-linked bond which pays quarterly. So again, there's that consistent income. Now, because I'm really pushing for time, I won't run through the rest of those figures. I will let you know, though, that the slides and a recording of the presentation will be made available to you, so you can have another read and a listen if you would like. But please let us know if there's anything specifically that you want more information on. So just in summary, we say that bonds are the next best investment to term deposits in terms of risk. And going back to that capital structure diagram, you can see bonds sit higher in the capital structure diagram than term deposits, but also lower. So we say that because they're that sort of step lower, that senior debt, we do say that they're the next best investment to term deposits. Now, a year-long term deposit will usually pay one interest payment at maturity, and you can request more frequent payments from your bank, but usually what they will do then is reduce the return because you then have the opportunity to compound that interest. However, bonds pay either quarterly for the floating rate notes and the inflation linked, or semi-annually or half-yearly for fixed-rate bonds. So they pay more frequent income, which actually is beneficial to you because you can use it or you can reinvest it. So you can then get the positive impacts of compounding. Bonds can be constructed really to suit individual investors. I think that's part of the beauty of the asset class. So depending on whether income's important to you or you know, you're looking for higher rates or you want low risk, whatever you particularly want or don't want in a portfolio, we can help or work with you to help define or decide what suits you best. So we'll make suggestions, but if there's things you don't like, we'll hunt down and look for other bonds that might be suitable. Again, we have that research, and would always recommend that you have a look for yourself try and find additional research on any of the companies that issue bonds. So next steps here. Further education. We feel very passionate at FIIG that investors understand what they're investing in. So we've worked hard to make as much information available to you as possible. One of the things that we published just last year, the Australian Guide to Fixed Income, it's the second edition, and nearly 300 pages of educational content. So the books can be in hard copy form or electronic form, and if you'd like one, please let us know. We also have a professional online course that has been certified by the Financial Planning Association, and that's worth 5.5 continuing professional development points. So if you're looking for even more education, that may be worth considering. Now, I'm hoping that you all get The Wire, which is our weekly newsletter, and we put out on a Wednesday morning. It would have come out this morning to you. So that's through The Wire you can keep up to date on what's happening in the asset class. So further steps, think about setting up an account if you haven't already got one. Perhaps reassess your current portfolio and think about opening an account, and then if you see a bond that you like, we can enact the transaction quite a lot quicker than if you don't already have an account set up. Consider bonds that might suit. Again, being an analyst and spending a lot of years in research, I think it's really important to understand the products you're investing in and the companies. Now, in our research reports, we certainly list why we like the companies and the bonds, but we also list the risks. So an earlier gentleman was talking about the Sydney Airport risk of them perhaps opening a second airport. That's mentioned in the report. So we very much want investors to understand the risks and what they're investing in. And finally, of course, start trading. So that really concludes the body of the presentation today. We do have some questions, so I'll hand over to Cam for a minute just to run through those final questions.
Okay, I think the question I've got here from Nima is just around the fixed interest educational material, and is it available on the website? Yes, much of it is available on the website. I think if you're wanting one of those guides, it's best to contact your local office and see if you can obtain a hard copy of that particular book, but you will find much of the information online. I should mention also that the online capabilities, once you are a client, are significantly enhanced in that you're able to view your portfolio, an interactive cash flow system which will show you when each bond is paying, how much it's paying you, etc. So you really can map out a calendar of income over across your portfolio. Liz?
Thanks very much, Cam. Yes, there's a lot of resources here at FIIG and experienced staff to help you to begin investing or to further enhance or analyse your portfolio. We certainly, it's a relationship-based business, so it's important for us to get to know you and what your needs are, and very much tailored, and certainly we're here to help in any way that we can. I'm hoping today that you've seen how taking some of your cash investments or your defensive cash and you investing in bonds has the ability to enhance your returns. You certainly are taking on a little bit more risk, but we think it's still very low risk, and the higher income can certainly make a big difference, not just in year one, but over the years that you're relying on that income. So I'd like to take the opportunity just to thank you all for joining us today, and if we can help in any way, please let us know. Thanks once again, and this now concludes the presentation.